Yo, what's going on, guys? Today I'm gonna be teaching you guys about fair value gaps, how to identify them, and how to play them into your narrative and your context. So let's get started. Okay, cool. So a fair value gap is a 3-candle price imbalance. It's also, you might hear busy or SIBI, which is a buy side imbalance, sell side inefficiency, or sell side imbalance, buy side inefficiency. It's all a fair value gap. It's all ICT concepts. At the end of the day, half the shit these people are teaching are just ICT concepts. Here's how you identify an FEG and what it looks like. Okay, so right here, we'll use this as an example. This right here is a fair value gap. Okay, so like I said, a fair value gap is a 3-candle pattern that forms whenever there's a lot of displacement. So right here, this is a perfect example. So the fair value gap is right here. So price comes up, and the wick, not the body, but the wick of the candle reaches maybe here, it doesn't matter where, but for instance, this one, the candle's here. Sorry, I got a phone call. So this wick right here comes up. You have this candle right here. This is the displacement candle of the FVG. It displaces up or down. This one, for instance, goes up. I'll show you a bearish one, but this is a bullish fair value gap. So it comes up, and then price on the candle after the displacement candle. So this final candle, it's a 3-candle pattern. 1, 2, 3. Okay, so it comes up, and then right here, it fails once it closes before the wick can come down and fill this. So the fair value gap is right here. How I get mine to look like this? This is my settings. I have it on extend right. I put on this is the background I put on. Leave it a little opaque. I like to put a middle line. You can write FEG if you want and shit like that, but I like extend right. Some people just do it like this and they manually drag it. I like this so I could always see it for infinity, for an infinite amount of time. So, also, highly recommended if you're not already, use magnet mode. I like using weak magnet, but use magnet mode because it's going to make it where whenever you, basically, here's the best way to show you. Magnet mode's like this, right? I'd have to sit here and estimate exactly where that's at. I might get it a little bit off. You want to be precise when it comes to trading, so you want to utilize something called magnet mode on TradingView. It's on a lot of platforms, really. And then right here, but TradingView's the main one. Right here and right here. You see how it just snapped to that? My mouse wasn't even fucking over that shit. That's how I do it. So this is a bullish fair value gap. And basically, what a fair value gap is, let me fucking find the text. Basically, a fair value, the best way to do it is think of it like this. So right here, we had a bullish candle coming up to retrace up here. Then this was the displacement candle, so it displaced higher, breaking these highs. And then on this last one, it doesn't have to break highs, but on this one it did. And then on this one right here, it came down and failed to fill this. So what does this mean, basically, and why is it liquidity? It is liquidity because there are resting orders in here. People were maybe waiting for it to come down and retrace back down to here to fill it like it usually does. Like, look, this wick here and this wick here, they even cross over. Or here's another example. This wick here came up, then this right here, this came down. Even if this came to here, I mean, this is a fair value gap right here. This isn't, because you see there's no gap, there's no overlap. So this wick comes up, this does its thing, but then this is the displacement candle right here. This is the fair value gap. They present themselves all the time, so don't look at any fair value gap and just be like, boom, I'm going to enter because there's a fair value gap. That's not the way to look at this. It's called a confluence, and confluences really depend on context and the narrative of the market. So fair value gaps can be used for entry, they can be used for other things, and I'll kind of show you how I do them in a little bit here. But this is how you identify a bullish fair value gap. So remember a gap between these wicks right here in the middle of a displacement candle. So basically there are going to be a lot of people who they saw this go up and break these highs. So they want this candle. They're hoping that one of these next candles come down and tap somewhere right here in and get a fair price, because they don't want to enter long right here, because if it goes down even this much, they're already losing money. They want to enter long somewhere right here, right? That's what they want to do. So they're waiting for it to come down and tap somewhere into it. Maybe it's the 50 line. Maybe it's just touching it in general. Maybe it's a full fill. Maybe it's seeing if it comes down and then trades back up. Whatever it is, they want to see how price, there's resting orders here, okay? Your job is to see how price reacts to these. That is your biggest job here. I'm not telling you to place a limit order at an FEG necessarily, but here is a perfect example of a fair value gap. It comes here, Actually, no, this is a fucking terrible example. That's an inversion, which I'm going to go over in a different video. Here we go. Here's a fair value gap. Now, with the market, it's not always going to be the most precise thing ever. I'm going to be completely honest with you. But this right here is what you need to look at. Boom, boom. That's a fair value gap, right? Can we agree? Can we identify these now? This wick, this is a little fair value gap. Okay, it's not a huge one, but here's what we saw from this fair value gap. We saw price come up, form a PD array here, come down. It may have filled it. That's completely fine. Damn it. Sorry, my girlfriend just got home. So this fair value gap was formed. We had a PD array form right here. And the market's not always going to be the most precise. We're just going to tap and then go up. So I'm not saying always expect it to go up. You want to see how price reacts to this. So here's how price responded. It came down, immediately came back up. It's a form of respecting, or rejecting. It's basically respecting it. It's saying, okay, cool. Came down. A lot of orders were probably filled here. That's why this move came up. Came down again, tapped into it, and skyrocketed. This is a perfect fucking example of if the other confluence is match up with it, it'd be a good entry. But some FVGs don't go filled for a long time. This one right here still hasn't been filled. It could come back down, and you never know. It could come back down. Price on a higher time frame, something like this, right? On the hourly, it might come down, touch right here, and then skyrocket. You never know. So it's good to map these out. Don't make it too complex, but I like to just look at them and be aware of them. So there are two main types of FVGs I want to discuss. There are high time frame and low time frame FVGs. On the high time frame FVGs, something like an hourly, right? We want to see something like this. This is a huge FVG right here. It's already been partially filled like this right here. I'm using this not necessarily as a confluence of entry, but more so as a draw on liquidity. So the market right now is currently rejecting after it tapped down into here. What I want to see is how price continues to react. If price comes above here and we get a strong, maybe an hourly closure above here, I would be pretty bullish into maybe taking these highs right here and place a trade there. Not just that, but this is just an example. Maybe it comes down and continues to take these lows. Maybe it comes down and does a full fill. That happens all the time, a full fill. Maybe it does a little bit of this, a little bit of indecision, right? But essentially on the high time frame, if we're not already in one, something like this even, this is a partial volume imbalance, which I'll get into in a later time. But look, price came up, hit the 50 level. It doesn't always have to hit the 50, but this is what I like using. It hit at least the 50 level, and it started tanking. So you can say to yourself, because it's in hindsight, the reason why the reason why price started trading down here and started retracing, and it decided to do that right here, and it never went any higher than this, yet at least, is because it took out this liquidity right here. So this is a PD array. There's an order block. There's several order blocks here. I'll get into order blocks in a later episode as well. But the main reason, think of it like this. You can also use this as an additional confluence. This is a hourly fair value gap. It's a very big one. And we came up. We tapped into it. I'm willing to bet you there were a lot of resting orders there of people who were bearish, there were a lot of sell orders here. So they sold, and a bunch of it started coming down. And that's what the selling pressure comes from in the market. Here's another example. This is a bearish fair value gap. Oh, this is a bearish fair value gap. This right here, price came up, tapped into it, fully filled it, even wicked above it, came back down and came up in the form of turtle soup, which is another thing that I'm going to have to get into in a later episode. There's a lot of terms, and that's why I'm here to teach you. Came up turtle souped, which is just a form of manipulation before it distributes. So I'll just quickly go over that actually. Price usually does one of three things. It's called power of three. It either let me find this. It either consolidates, so just up, down, kind of like a barcode, just very stagnant, not creating any new like crazy price action, just going up and down. It distributes higher or lower, like this maybe, or it manipulates. For instance, a perfect example of manipulation. A perfect example of manipulation would be this right here. Because price came down, wicked right here, and then started trading upwards. That's a form of manipulation. So I don't want to get too ahead of myself here. That's not what I'm here to do. My main thing is what I'm telling you here is price came up, touches fair value gap. I would have used that as one confluence on the high time frame of maybe the liquidity we're trying to grab. You can't just say to yourself, it's going to do that, and then it's going to trade down. I don't know. It could take this high. It could take even more highs. You never know. But what did I see? What did the market show me? The market showed me that this came up. We manipulated up a little bit too, but we respected this fair value gap. That's what you need to pay attention to. We respected this fair value gap, and we haven't even touched it since. We could whenever we go bullish again, because the market goes up and down. It doesn't just go up. But just things to be in mind of on the higher time frame. That's what I'm saying. On the higher time frame, what I like to do is just mark out some close or near FVGs. So this is one FVG or fair value gap. This is the one we're in, and then I don't really see any worth a damn. But maybe down here, this is all sell side, and this is all sell side liquidity right here. This is now buy side liquidity, which basically just means when the price comes up, it could take this out because there's going to be resting orders here, come down. The market just, long story short, the market moves in liquidity. So I'm looking to see if price respects this fair value gap, because look, this you could say, I'm not saying this is what's going to happen. Let me make this shit favorite because this is pissing me off. This right here, I could say the same thing could happen here, because look, it came up, came down, came back up a little bit, and then started tanking. I could say the same thing in the inverse, where it came down, filled the FEG partially like it did right here, came back up, and then failed to break this, made a higher low, and then maybe continued to skyrocket. You never know. But it all starts, you think of your confluence as like your tools. They're your tools. They're just tools. They're not tells like, oh, the market's going to go up or down. That's not necessarily what they're telling you. They're telling you why the market might be going that direction. The market is currently going down. I want to know why the market's currently going down. Maybe to fill this fair value gap. If the market's going up, maybe to retap or to disrespect this fair value gap and just skyrocket. Sometimes it just skyrockets and disrespects them because a lot of people know what fair value gaps are. Let's see here. Context is always super important with this shit. Always make sure that you have the proper context when it comes to these things, where you know it's not. You're not just entering off it. You're not just finding every FVG in the fucking market. Because I could sit here and I could start mapping out every fucking FVG. A lot of people do it. I could start marking out every single FVG and then be like, oh, well, it came down and touched this FVG. Why did it come back down and disrespect it again? It's because you weren't paying attention to the context, what the market's trying to tell you and what it's currently doing. You need to look at what it's currently doing. Quit looking all back here all the time. Look back here for notable signs of liquidity and see what the market is currently telling you. Right now, the market is currently telling me we are in a sell program. We're currently going down and the sellers are in control. You can't really know exactly how far that might go. It might go to here, it might skyrocket, it might go to here, it might continue to tank lower. We have no idea. But at the end of the day, a successful trader isn't one who speculates, it's one who just adapts to what the market tells them. Okay, and then low time frame fair value gaps. So I'm going to delete these for simplicity's sake and go to something like the 5 minute. So a low time frame fair value gap, let me find a good example. This right here is a great example. A low time frame fair value gap. So remember, like I said, it's not always going to be the most precise thing in the world because the market is very volatile, right? Something like this would be, if paired with other confluences, i.e. order blocks, inversion fair value gaps, breaker blocks, narrative, premium and discount, OTE, whatever it is that you use, you pair it. You pair it with confluences and whatever the market's telling you. So this is just one example. The market comes up, creates a fair value gap in the form of displacement, comes back down, taps into this, and continues to trade higher. A lot of people probably thought it was going to tank here because of this manipulation right here. If you usually see a long wick, it's probably a good sign that it's manipulation. If you just see a really, really long wick or a diddy candle. But if it comes down here, you see how it taps in right here? This is this kind of shit I'm telling you. You need to pay attention to shit like this because what I'm looking for, and here's how you really apply it on the low time frame, what I'm looking for is to see what price, because this is much closer, right? I'm trying to see if price comes down, if it taps this and rejects, or if it breaks below, maybe comes back up and turns into an inverse FVG, okay? But that's, inversions are for later dates. But for high probability fair value gaps, I'm not looking at something like this. In the middle of the range, right? Because there's liquidity ranges. This right here would be like an internal or an external liquidity range. This to this. And this right here would probably be more of the internal range, right? This is kind of what we got going on right now. So price is moving to either go from internal to external or external to internal. That's what it does. So this is internal. It's going to try to move to external, like take this out, and then come back in an internal trade, come up, take another major high or low, and that's just what it does. But at the end of the day, this is the middle of both ranges. I don't really care about this fair value gap, and this is why this is why I've had so many problems with FVGs in general, is because I didn't fucking realize that that you don't just trade any fair value gap or look at any fair value gap. You look at specific ones. You look at ones during closer to areas of liquidity because they're more high probability. This right here, you saw it reject. You might even see it like reject several times. That would be a strong FVG, and that really goes for any confluence. Order blocks, breaker blocks as well. This is also pretty close to this swing low right here. But I don't know, just something like this. Let me get it. Something like this just seems so insignificant to me. It's like it comes up, it just breaks above it. It might come back tap, but what matters more about this is that it turned into an inversion. That's what matters. It turned into an inversion. But I can go over inversions at a separate time. So just remember, they can act as, I hate using these words, support or resistance, depending on the context. The context right here is that price came down and rejected off of this. That makes me think this is a high probability fair value gap. That doesn't mean I think it's going to continue to trade once it comes down here. I think it could, but I want to see what price does. So anyways, that's basically how I trade FVGs. Leave it in the comments if you have any questions. If you're already in my community, just ask me in there, and I'll see you. Peace.